Good afternoon, traders and investors. Will back here with another one, coming to you with a Tuesday market update. So today's markets, guys, was really a story of rotation. QQQ was having a break after big tech reported earnings over the last 2 weeks and mostly beat across the board. And now QQ is taking a little bit of a break while the rest of the market makes up for it. And that is leading into some very decent, healthy rotation, which is what we want to look out for on the channel. So in today's market, SPY and QQQ spent most of the day in the red before really recovering heavily into the end of the day. But XLF Financials and XLV Healthcare were always green on the day. And that is what you want to see, guys, when technology is taking a little bit of a break, when semiconductors are taking a little bit of a break as well. You want to see the rest of the market recovering, and even our growth stocks getting some love today as yields have come down over the course of the day after our most recent negative headlines yesterday with services inflation and Federal Chair Jerome Powell's comments on Sunday night in terms of no more rate cuts. Well, yields have since come down, which leads into my argument that most of the yield increases so far have just been a case of speculation, nothing more, nothing less, just overall going to be trending to the downside over the next year as rates do eventually come down into the later part of this year. So in today's video, guys, we are going to cover a couple little bit of elements. We're going to first cover what happened with Chinese stocks today. They had a heck of a rally after the government once again came in and started backstopping the markets. We're going to take a look at 3 earnings reports that I have prepared for you guys in the names of Fortinet, Elf Beauty, and Chipotle. And then we're going to get into our technical analysis of our major indexes and our major tech names, and lastly conclude with my portfolio. So without further ado, guys, let's get right into today's video. SPY up 0.29%. QQ still red on the day, 0.2%, but very beautiful rotation across the board. And when I pull up the heat map, that is exactly what you guys will see. The bottom half of the market making up for a little bit of tech losses. So semiconductors having a beautiful month of January, but as we were saying, conditions were getting fairly overbought across a number of names in here. And now we finally have a little bit of a warranted pullback. The rest of big tech fairly muted on the day, Apple with some gains, but Microsoft coming off its earnings highs, Meta as well coming down off of its earnings highs, and Amazon too. So a little bit of a pullback in our tech sector, but very healthy rotation across the board. This is exactly what you want to see, guys. When some of the names have been overbought for a while in big tech, they take a little bit of a breather and the rotation just continues into the bottom half of the market. On a one-day relative performance, you'll see that everything except for technology was in the green, a perfect case scenario for your broad market bulls. So before getting into more technicals, guys, let's break down what exactly happened with China stocks today as they had a heck of a rally. Alibaba stock up pretty much almost 5% here. JD.com also up 7.6%. Pinduoduo, some of the largest names here, up 4%. Very nice broad market recovery in terms of Chinese stocks. What exactly happened? Well, here's the headline. China is pumping money into stocks and markets are loving it. So quick reminder, guys, the Shanghai Composite, which is pretty much an aggregate of your Chinese markets, has been heavily down over the course of January, right? Peaking over the course of this week, down almost 7% year to date. Very bad performance. And on a one-day relative basis, it's not any better. On a one-year relative basis, it's not any better, right? Stock market down pretty much 14.2%. 5-year basis as well, only up 3% in the last couple of 5 years, guys, which is very, very down, significantly off your peaks back here in the later part of 2021 as well. So something had to be done, and China finally stepping in to do something about it. Now, Chinese stocks staged their biggest rally in years Tuesday after the country's sovereign wealth fund said it would step up by buying shares as officials scrambled to draw a line under a 3-year market route. The rebound in Chinese stocks came after Beijing stepped up its efforts to prop up the A-Link stock market, which had a dire 2023 and has been the worst performer in the world so far this year. By Monday, about 6.1 trillion in market value had been wiped from Chinese and Hong Kong stock markets since their recent peaks in February 2021, which is what we were showing you pretty much on this chart right here. Now, the Central Huijin Investment, the equity arm of state-owned China Investment Corp, announced Tuesday that it had recently expanded its holdings of ETFs on mainland stock markets. We will continue to increase our holdings and expand our holdings to resolutely maintain the stable operations of capital markets AKA the government is stepping in and starting to backstop the markets. We had headlines of this 2 weeks ago when it was going to use some offshore accounts in order to bolster ETF purchases by the central government. But now you actually have the equity arm of the government itself stepping in and starting to increase holdings and backstopping the market. Shortly after the announcement, the China Securities Regulatory Commission, basically the SEC for China, issued a statement saying it firmly supports the investment fund in its plan to continue to increase the scale of its holdings. So broad-based support by our Chinese government here in terms of backstopping the markets. The regulator said it would also encourage more institutional investors, such as mutual funds, state pension funds, and insurers, to enter the stock market after pretty much nobody in the world wanted to touch Chinese markets because of their most recent sell-off and because China is going through a little bit of a recession right now. Well, the CSRC is trying to bolster an encouraging message here in terms of trying to attract foreign investment, since they now are backstopping their own economy, showing confidence in their own economy and trying to get others to follow suit. The intensified efforts came after Chinese markets resumed their slide on Monday when more than 1,800 stocks fell by more than 10% in Shanghai and Shenzhen. This was a huge drop on Monday in the markets, after which angry investors flocked to a social media account of the US Embassy in Beijing to vent their outrage about the meltdown of the stock markets after other outlets of protest had been closed off. So after such a firm backlash on social media by retail investors and institutional investors alike, and with such a flight of capital from Chinese markets over the past year, well, now the Chinese government is finally doing something about it. So moving in the right direction. I'm very, very pleased to read those headlines. Could just be a bottoming out process of a lot of your favorite Chinese stock names. So that being said, guys, let's now get into our earnings plays for the day that we were looking at. So we're going to be covering today Chipotle, Elf, and Fortinet, but notably a lot of other companies at earnings today in the names of Eli Lilly, which performed fairly well. Spotify as well did fairly well. Enphase actually coming out with a beat, so may be signaling a bottom, and I actually like their guidance in terms of their guidance for 2024, may be signaling the bottom of cyclicality for solar stocks. And we did have a few other names as well. Tomorrow we have a very big day too. We're going to be covering Baba, Uber, PayPal, Disney, even ARM Semiconductor play has earnings tomorrow. So lots of earnings remaining in the week. And then Thursday, obviously, you have a few more names, and the names of Affirm, your buy now, pay later service, Pinterest, Cloudflare are going to be another cybersecurity play that we're going to take a look at after Fortinet's beautiful earnings from the day. Expedia also we're going to want to take a look at in terms of seeing how the consumer is dealing with their vacation expenses and discretionary spending too. And then Friday, one of my favorite companies is reporting, Pepsi. So on Friday, since only Pepsi is the one I'm going to be covering, I'm going to probably go over a few of them that we missed throughout the week that I do feel that are noteworthy to bring to the channel. So let's get right into our first earnings play, and that is going to be Fortinet. So Fortinet's been a stock that I've been talking about religiously on the channel at this point, naming it one of my favorite security plays for the next couple of years, and they did not disappoint on their earnings, up almost 13% in the after hours, coming in with a very healthy double beat on EPS for the quarter and beat on revenue. But the story of this company, guys, has been their diminished guidance over the past 2 quarters. In the past 2 quarters, they were hinting at the cyclical nature of cybersecurity and corporate spending on software as a service as a whole. As you well know, that in the past couple of quarters, there's been a big concern with a recession into 2024. And usually when you have concerns of a recession, a lot of major corporations do 2 things. Number one, they'll downsize in employees, which is what you saw all across big tech over the past 2 years. And they also, number 2, stop spending on non-essential lines of business, and namely cybersecurity, guys, tends to take a little bit of a hit in that case because companies did scale back on their purchases and subscription services to these cybersecurity companies. But now, after today's earnings with Fortinet, it seems as though we have reached a cycle bottom for that as well. And Fortinet issuing some very healthy guidance for 2024, meaning that the large part of their cyclicality of the downturn in revenues is now largely behind us. So very pleased to see this report. Let's get into some headlines here. Fortinet stock jumps on Q4 earnings, revenue, and billings beat. Very, very decent. Fortinet on Tuesday reported December quarter earnings, revenue, and billings that topped analyst estimates amid lowered expectations, which we're talking about. Cybersecurity firms' 2024 revenue and billings guidance for Fortinet stock came in better than feared. So that was the major headline that we want to take a look at. For full year 2024, Fortinet said it expects earnings per share in a range of $1.65 to $1.70 a share. That was better than what analysts had projected of about $1.66. So kind of still in the same, but they did guide towards the higher end of your EPS range. They also forecasted revenue in a range of $5.71 billion to $5.81 billion. Now, this was pretty much a bit lower than the expectation of 5.93, but not as low as some analysts had expected in terms of scaling back of their operations due to the cyclical nature of their business, potentially with some recession fears. So really good guidance here, guys. It could not have been better guidance. The guidance is still a bit low, but keep in mind, it could have been a lot worse for the company after what they had been projecting over the last 2 quarters. So it seemed as though they had done a really good job of managing investor expectations in the past 2 quarters leading into the massive stock sell-off. So how exactly is Fortinet doing in terms of their company? Well, Fortinet has always been growing fairly decently, guys. If you take a look down here, you'll see that this company has no problem maintaining very healthy margins, always between the range of about 20-25%, and they do grow, and they are very stable in terms of their balance sheet as well. If you take a look down here, you'll see that in terms of your quarters, right, we're generating a decent amount of free cash flow in relation to the debt we have. We're generating about $500 million, or just shy of there, in terms of free cash flow on a quarter-over-quarter basis, and the company now has about $2.2 billion in cash and cash equivalents on the balance sheet, and they don't have that amount, they don't have a lot of debt, guys, only $1 billion in debt. So this company's balance sheet is extremely solid, and they do have expanding metrics in terms of their EPS and in terms of the revenue. Now, 2024 should be a transition year for them as well, as they kind of manage expectations. And, when companies will be resubscribing to their business coming out of the recession headlines, obviously it'll be much better for them, most likely in 2025, but still we're not dropping. That's the most important part, guys. Still increasing EPS for 2024, not that much, but still decent. And then 2025, 2026, 2027 remaining, going back to 20% EPS growth on a year-over-year basis, which is very good for the company. And revenue, even though revenue this year won't come in that great in terms of expansion, only about 10% revenue estimate expansion for the year. Thereafter, guys, it does become a bit more juicy. We're talking about, anywhere between 15-17% in revenue. So 2024 should be a transition year, but still nothing bad for the company. Now, let's take a look at some of their slides. So segment breakdown here and Q4 billings. Actually, we're going to start up here. Here are your financial headlights. So you'll see that nothing is wrong with the company whatsoever. Total revenue, 20% year over year. Very good. Service revenue, where they make a lot more margin. So this company sells products and services. Now, their service revenue always brings in a lot more margin. So it's really good to see them grow 28% year over year. Their total billings is up as well, $6.4 billion in total billings for the foreseeable future for fiscal year 2024. So that's very good. Over 1 year of total revenue still in billings to be fulfilled. Recurring revenue represents 66% of their business, so that's why they're able to generate a decent amount of margins as well. And you can see here that they did generate almost $2 billion in free cash flow, as I was showing you guys before. Not a lot of debt for the company. So here's their segment breakdown for their billing. So they have a secure networking division, which is what the products. They sell a product suite that can be installed. So these are actually physical products that they sell to consumers and to businesses. Now, what they want to move towards is this unified SaaS. This is pretty much their software as a service business, and a lot of people, this is managed in the cloud. So a lot of businesses do now have a penchant for everything being managed in the cloud. So we're going to need to see Fortinet increase this aspect of their business, which they have hinted that they are going to do. And then they also have 11% in terms of their security operations, which is just pretty much a continuously monitoring of networks. Now we are in a market that does have a total addressable market expansion here. So 150 billion in 2024, growing to 208 billion by 2027. So very decent growth of their total addressable market. And they only have a relatively small portion of this, right? So it's really representing some good growth over the next couple of years. You can see here the projected compounded annual growth rate across all the lines of businesses that Fortinet does have is expected to grow really very nicely, 8% secure networking, and then double digits for both security operations and unified SaaS. Now, this is another good one. Fortinet secures over 500,000 organizations worldwide. So very popular company, guys. Over 700 200,000 enterprises, service providers, and government organizations trust Fortinet to secure their operations. 76% of Fortune 100 companies depend on Fortinet to stay secure, and this is why they are one of the market leaders in what they do. Top 4 out of 4 business services companies are with them. Top 8 out of 10 financial service companies are with them. Top 9 out of 10 healthcare services are with them. And the list just continues. You can see they have very decent market coverage in terms of being partnered with the leaders of each one of these industries, which all use Fortinet. Very, very healthy, expanding business as a whole. We're going to get down into just one thing that I did want to show you guys in terms of that. In terms of their balance sheet, we're not going to go through everything because the company is relatively stable. So we don't really have that big revenue expansion for 2024. We don't really have that big EPS expansion for 2024. But what they do have is a solid balance sheet to fall back on. They do generate a significant amount of profits, and they do really have very decent cash flow. And you can see this down here, free cash flow and adjusted free cash flow growth. Very nice free cash flow expansion for the business. So this business is exactly what you want to see, guys. It is number one. I'll move myself over, is number one, a decently high margin business. Net margins over 20%. They are also growing EPS over the next 4 years, growing EPS fairly steadily and growing revenue fairly steadily as well. Decent amount of free cash flows too, and a solid balance sheet with not a lot of debt. This is why I love this company. And the company is still trading relatively off their all-time highs before earnings, about 17%, now only about 7% off their all-time highs. So I really love this business, guys. It's one of my favorite cybersecurity plays, and I hope I was able to show you why they have very decent partnerships with industry leaders and their financial metrics are very good as well. So that's pretty much everything I had for Fortinet stock. Now, what we're going to do is we are going to get into our second earnings of the day, which is going to be Chipotle. So Chipotle needs no introduction, fast food chain across North America, right? And guys, they absolutely crushed it after earnings. Now, their stock is only up about 2.66% in the after hours after earnings, but this stock has had such a significant rally since October. We're talking about almost 40% since their last earnings cycle. So very good growth. Chipotle currently at all-time highs. Now, why does this company keep growing? Some of you might look at this stock and figure, why is this company growing at the rate it is? Well, very easy, guys. It's very easy, right? So they do have decent profit margins. We're going to get into their breakdown as well. So look at this revenue expansion by the company, guys. This is where it really counts. They have over 10-15% revenue expansion per year. Decent profit margins for the nature of the business that they're in. We're talking pretty much about 10-12% per year, which is very decent. That's right in line with a company like Starbucks. McDonald's, obviously the industry leader at about 30-35%, like we saw yesterday. The company does have a fair amount of debt on its balance sheet, but that's only in relation to the amount of free cash flow and cash equivalents that it has on the statement. But you can see here only $4 billion of debt, guys. That's really not that much when you consider that this company brings in terms of revenue on an annual basis, right? Almost $8-9 billion of revenue on an annual basis. So really not a lot of debt. Now, they don't generate a ton of free cash flow, but that's because they're continuously expanding their network of stores and reinvesting into the business to develop new processes, which will improve their margins over the long term. And we're going to take a look at exactly what some of those do entail. So the company is financially sound. They're expanding well. And they have a very loyal customer base. Now let's take a look at the headlines. Chipotle earnings crush estimates as restaurant traffic grows 7.4%. So they did have a double beat on earnings, beat on EPS by about 7, beat on revenue as well by about 1%. But this is what I want to draw your attention to. Do you remember Starbucks and McDonald's earnings from a few days ago? We were talking about the traffic only being between 4 and 5% growth and the same store sales being between 3 and 5%. Well, take a look at Chipotle's numbers and now you'll see why they are one of the favorite plays in terms of fast food. Now, Chipotle said foot traffic rose in the quarter, bucking an industry-wide trend of declining visits. They're talking about Starbucks and McDonald's. Now let's get into the gist of things. The company's same-store sales rose 8.4%, not 4, not 5. The healthy amount, 7 to 10%. The company's same-store sales rose 8.4%, beating the estimates of 7.1. Executive said sales grew across every consumer income level. So people must love their Chipotle, right? Chipotle said foot traffic rose 7.4% in the quarter. So very good, bucking an industry-wide trend of declining visits. Restaurant giants McDonald's and Starbucks both reported traffic declines for the last 3 months of the year. Additionally, Chipotle sales received a boost from a 3% menu price increase it implemented in October. So Chipotle apparently still having pricing power. We were talking about McDonald's the other day and how McDonald's is running out of pricing power because it's ever since it's increased prices over the course of the year, it's seen a decline in same-store sales and decline in foot traffic. Well, Chipotle still has pricing power contrary to what the rest of the industry is facing. Looking to 2024, Chipotle is forecasting full year same-store sales growth in the mid-single digit range, so about 5, 6, 7%, and plans to open between 285 and 315 new locations. Very good. Also in 2024, Chipotle plans an in-restaurant test of a robot that scoops avocados called the Autocado, an automated make line for its burrito bowls and salads. Both robots have already been tested in the company's innovation center. Now, this headline may not seem a lot to you guys, but when I hear stuff like this, I just think of net margins. If they can improve, obviously in food companies, a big portion of your cost is the employees preparing the food. If you can get robots to do this, it means that employees can be doing other things like actually serving the food, which is going to improve their net margins and improve their operating efficiency. So I really like this. So whereas this company is now making between 10 to 12% net margins, after a successful implementation of methods like these, they may be able to increase margins substantially. And when you're making a few $1 billion a year, even a 1, 2, 3% increase in net margins is millions and millions of dollars to the bottom line. And that's exactly what investors want. Now let's take a look at some of their financial highlights from their earnings release on their website right here. So full year 2023 highlights for the year that's just ended. Total revenue increased 14.3% to $9.9 billion. Comparable restaurant sales increased 7.9%. These are fantastic, guys. Operating margin was 15.8%, an increase from 13.4%, decent increase in operating margin. Restaurant level operating margin was 26.2%. Diluted earnings per share increased 38.4%. Such a phenomenal increase in earnings per share. Opened 271 new restaurants with 238 locations, including a Chipotle. Chipotle obviously is going to improve their efficiency as well. It's contrary. If you guys don't know what a Chipotle is, pretty much is it's not really a drive-through service. You have to order the food before and then you come and pick it up in the drive-through lane. So it basically really helps in terms of your drive-through times, right? When you don't have to put the order in, the food is just ready. You just scoop it up and go. It really improves the efficiency, contrary to other locations like Starbucks and McDonald's, where you actually have to order when you're at the drive-through lane, right? So very, very good. We're going to bring down here. I think I have highlighted a few more things for you guys. Oh no, I didn't highlight anything in Chipotle because there's nothing much to see. What I did want to bring your attention to, guys, is the EPS expansion over the next couple of years, right? So take a look at the forecast on EPS expansion. Look at this EPS expansion. This is pretty much 20% a year, guys. Absolutely phenomenal EPS expansion. 20% is amazing for any company, let alone a company that's already doing this amount of numbers. And revenue expansion, you can see here as well, about 10, 12% for revenue expansion, but EPS is really where you want to see it, guys. So the company right now may be trading at about a 58 price to earnings ratio, right? But with a company growing EPS so fast, if you take it in terms of their 2024 ending EPS right here, so let's take their current price right now, let's call it about, 25.50-ish. So if we take 25.50 divided by 53.41 in EPS, that's about 47 forward earnings. Now that's still expensive, but we have to keep in mind their growth rate. They're growing EPS 20% for the next 4 years. So let's take a look at their PEG ratio, guys. So if we do pretty much 20% EPS growth divided by their, we take their price to earnings divided by their EPS growth of 20%, 58.62, which is currently right now, right? 58.62 divided by your 20% EPS, which is about 2.9 PEG. Now you usually want anything under 2 for a growth company like this is pretty good. So Chipotle still trading relatively rich in terms of multiples and in terms of valuation right now. I really would like this company, guys, and I'm not saying it's going to get there. I would like them if they get back at this point with their 2024 guidance. Of course, if they get back to about $2,100, I may be able to take a little bit of a nibble on Chipotle, but for now, the stock is pretty much just running away from us right now. Really like everything the company is doing. It's just the valuation right now is a little bit stretched in my opinion, but as you've seen from our financial breakdown right here, there's really no red flags. Same store sale growth is actually insane. revenue expansion, net operating margin expansion. They're trying to do stuff with robots, right, to improve operating efficiency as well, and continuously expanding their network by opening roughly between, 300 and 400 new stores per year. That's absolutely amazing. Nothing bad to say on Chipotle whatsoever. And now lastly, we're going to get into one of our high flyers, guys, in the name of Elf Beauty. So Elf Beauty has been an absolute killer story over the past 2 weeks as their viral marketing has propulsed this company to be generating ridiculous revenue growth. We're talking 80, 100% revenue growth on a year-over-year basis. You love to see it, but now at this point, guys, the revenue, the valuations are getting a little bit rich even for me. Now, I really like this one when I presented it back on the channel under $100 when we were in this massive dip over the course of November and December, but it has since pretty much almost 2x since that point, and their revenue expansion, although good, their multiples are getting fairly up there, guys, and we're going to show you that in the next couple of minutes in order to show you exactly why they're so overvalued. So let's take a look at their financials. Financials relatively good here, guys, right? So on a quarter-over-quarter basis, you can see they have a decent amount of cash and cash equivalents and not so much debt. We will even see that in their earnings report. So company almost has no debt whatsoever, right? This is a company that's bringing in terms of a quarter-over-quarter basis, they're making about, but anywhere between $25 and $35 million per quarter net income, and their debt is only about $81 million, right? It's not that much at all. Decent amount of free cash flow generated from their net income and decent amount of cash and cash equivalents on the balance sheet currently. So really no problems on their balance sheet whatsoever. Now, let's take a look at their earnings expansion, right? So earnings expansion is expected to be very high for the next couple of years, guys, right? We're talking pretty much at this point, it's going to be roughly about 20% revenue EPS expansion for 2024 and 2025. We don't have 2026 projections, but let's just take 20%, okay? Revenue expansion as well is expected to be very good, with the company eclipsing the $1 billion mark at the end of 2024. So their revenue expansion should be as well about 20% here for 2024 and 2025. So very good. But if we take into account their current price to earnings ratio, which is roughly 80 before earnings, right? Their EPS is growing at about 20% per year over the next couple of years. We're already almost through 2023, so we're not going to take that. We're going to take their forward EPS to determine their PEG ratio. So in terms of forward EPS of 20% and your price to earnings ratio of about 80, right? 80 divided by 20, which is your EPS growth rate. They're sitting at a PEG ratio of about 4. So similar to Chipotle, I love the company. It's just now at these prices, in terms of how much they'll be growing, very expensive, guys, right? The stock was trading at half of what it was about a couple months ago. So at this point right here, your PEG ratio would have been half because it's half the price, right? It would have been about 2 back then, which was really good for the number of growth that Elf was putting out. But still, nothing wrong with the company other than its share price right now. So let's take a look at what they did. Elf Beauty blows past Wall Street's estimates, raises guidance for a third quarter in a row. Absolutely amazing company, guys. The viral cosmetics brand known for products such as Glow Lip Oil and Halo Glow Skin line sales grew 85% during its holiday quarter, on top of 49% sales growth in the year ago period. And the CEO goes so far to say, we can continue this momentum. So he's very, very bullish on the company. Elf Beauty, the viral brand beloved by young consumers, raised its guidance for the third time in a row on Tuesday. The company saw torrid revenue growth even as it faced tough comparisons from year-over-year comparisons, of course. The jump came on the heels of a 49% sales increase it saw in the year-ago period. So companies growing, in the past 2 years has really been the growth story of Elf. Now it's going to slightly taper off, but you can see here, it really started accelerating here. And now the revenue is going to be a bit more streamlined, right? So you can see it's not going through the roof exponential to $2-3 billion. They've really hit their exponential growth now up to $1 billion. And then after $1 billion, it's only going to be about 20%. So it's not going to be, the comparisons between 2022 and this year, unfortunately. But sales rose to $271 billion, up a staggering 85% from $146 million a year ago earlier, which is what we were just showing on the chart. We can continue this momentum, said the CEO in an interview. As much growth as we've seen, I feel we can double our market share in color cosmetics over the next few years. Very good. We have an even bigger opportunity in skincare and then international. We grew 119% during the quarter. We're still in the early days of international expansion. This is true. They haven't really expanded internationally. So we'll be curious to see if they can tackle legacy brands in the names of Ulta Beauty and Estee Lauder on an international basis as well. The beauty brand has won over Gen Z and Gen Alpha consumers with its viral TikTok marketing and its ability to produce high quality product dupes that mirror prestige makeup brands, but come at a fraction of the price. So pretty much like the Alibaba of your cosmetics segment, right? But very good, guys. It's exactly what you want to see. They're targeting the younger generation of consumers, which will be your trendsetters over the next 15 to 20 years. And they are really starting to take away market share from your legacy companies and changing up the way that they do marketing using social media as their number one vehicle. The company's ability to tap into the cultural zeitgeist with short form digital content and create affordable products that resonate with consumers has paved the way for its outsized growth. So company really in tune with how to do marketing for beauty products in 2023 and 2024. While the bulk of e.l.f. sales came from its wholesale channels within natural retailers such as Walmart and Target, the company has been working to build out its digital business, so direct to consumer. From their website, right? Online sales represented 24% of overall revenue during the quarter, compared to only 15% in the year ago period. So very good growth, pivoting to online. This is going to reduce their cost of business as well. If they can start generating more revenue from online sales, well, it obviously improves their operating efficiency, because then they don't have to ship the products to Walmart and Target and shelve them and pay for shelf exposure and whatnot. They can just ship it directly from their website, but they've done a very good job of really being present in your largest companies in the world at this point. Well, Walmart for one, and then Target in terms of a very big retailer as well. Let's take a look at some of the highlights that I have here from their quarterly announcement, right? So balance sheet as of December 31st, the company had 72 million in cash and 164 million of long-term debt. So really not a lot of long-term debt, guys. You know, they bring in about on a year-over-year basis, right? Pretty much like about $100 million net to the bottom line on a year-over-year basis, $115 million. So that's not too much debt whatsoever. In terms of the growth that they have, usually you see companies spend a lot more money than this for them to have growth, but the company has been able to grow without using a lot of debt. So that is very, very, very good. Now, they did update their 2024 outlook, and here are the numbers, guys. So here is your previous outlook right here. So they were forecasting a midpoint of about $900 million for net sales, increasing that 10%, now closer to $1 billion. Very good. Adjusted earnings before interest, depreciation, and taxes, otherwise known as EBITDA, that is also up a very healthy other 10%, right? So from about 200 million to about 220, another 10% boost in your earnings here. Tax rate, we're not going to talk about. Adjusted net income, also a healthy boost, guys. Very healthy boost, talking about 30% boost in adjusted net income. That is exactly what you want to see. Very strong growth from them, about 20%, excuse me. So very, very, very strong adjusted net income guidance increase from them, and EPS increase as well. And the shares outstanding are still largely the same. So that's pretty much everything I wanted to show you for e.l.f. I mean, there's nothing notable to go through their balance sheet, guys. As I've shown you guys, you know, they generate a decent amount of free cash flow for what they are. The only problem right now is their current valuation. The market cap just not, you know, just a bit too high for my liking personally. I love them when they're about a 4 or 5 billion market cap down here, because then you could justify the PEG ratio, the price to sales ratio, and other metrics that we use for growth companies. But at this point, little bit rich for me. I'm not saying that the share price couldn't continue to improve. Obviously it could, and continue to get even more overvalued, but I'm not in the business of buying overvalued companies, guys. I'd rather wait for the price to come back to me. If it does come back in, let's say, the 140, 130 range, I may be tempted to take a little bit of a swing trade. But as of now, I think I'm going to sit on the sidelines for this very good company. I have nothing bad to say about the company whatsoever. They're growing substantially. It's just valuations right now, even considering 2024, 25, and 26 are getting a little bit out of hand. So that's everything that I had for your earnings plays for the day. Let's get into our major rundowns here on your technical analysis. Now let's move into SPY. So SPY looking very good, guys. Take a look at the futures chart. Futures chart shows a better picture, right? So daily uptrend confirmed. Daily bull flag sitting on previous resistance at this point on SPY, using that as support. This is a daily bull flag, guys, right? Could just expand further to the north at this point. Daily bulls are in full control of the move. We're looking for the daily higher low. After the daily higher low is set, you pretty much have continuation of the daily uptrend, and bulls never really losing this hourly time frame. We are just setting a tightening range at this point. So we'll see how it continues. But even if we do pull back here, guys, looking anything above 483 roughly, just going to be looking for a daily higher low, keep an eye on your 12 EMA. 12 EMA has been very good line of defense this entire time. No red flags. As I continue to say, it is up to the bears to prove to us that they can set a daily downtrend, and only if they do that will we be in weekly consolidation. For now, weekly trend just continues to expand as long as this daily trend remains healthy. QQQ, same concept as well. Take a look at your futures. Futures shows an even better picture, right? Daily bull flag at the top, looking for trend expansion. QQQ largely the same, right? So QQQ currently in a very nice daily uptrend. Any pullback at this point, we're just looking for a daily higher low. Anything above 417 is your daily higher low for further trend continuation. Bulls in full control, never really losing the hourly time frame right after this little dip right here, and currently setting the new daily higher highs in motion, never losing the hourly uptrend. 4 hour, still playing defense around this 12 EMA, but your daily really need to watch out for this 12 EMA as well. QQQ loses it more times than SPY, and when it does, it becomes notable to us, but for now, fairly decent recovery, and wouldn't be surprised if we get some continuation here, but just keep in mind, guys, February seasonality, right? Mid to late February is when we may start to get a little bit of your weekly consolidation in the markets. Now moving into financials. Financials performing very well while QQQ was taking a little break. Financials doing very good. Now we do have just consolidation here, guys. Very nice consolidation range at the top end of this move. That is exactly what you want to see. After such a nice move, the bears never able to take back much more than about 38.2% of the move. And now we're just pretty much in a tightening range, holding well above our 12 EMA. So daily bulls are in full control at this point, guys, right? Just looking for the tightening up of this range. If we do start getting a break to the upside, we'll be looking for daily uptrend continuation past 39.40, guys. And then we're pretty much looking at your $40 is going to be the level of resistance. And then it's all the way up to the all-time highs, 41.50. So financials looking fairly healthy, no red flags whatsoever. That you can see at best on the 4 hour time frame, right? Really nice tightening up of this range. So as long as we're playing defense at this 12 EMA, your bulls remaining healthy, daily higher low is set, tightening up of the range. Now we're going to be looking for further trend expansion. Why? Because your weekly bulls are in full control of this weekly uptrend, and monthly bulls full control as well. So usually when we have tightening ranges like this at the top end of the move, they do tend to break bullish. Now moving on to XLV Healthcare. XLV Healthcare, guys, what happened today? Well, new all-time high on healthcare ETF. So daily uptrend healthily in motion at this point, fitting for healthcare, right? So trend expansion to the upside at this point. Anytime we get a pullback after this move is finished, how do you know the move is finished? Well, need to lose this beautiful hourly uptrend, right? If we lose the hourly uptrend, we will be in for daily consolidation. But as of now, no signs of that. Once we do get daily consolidation, anything above 137.23, just going to be looking for a daily higher low for further trend continuation. Looking very beautiful on the monthly as well. Weekly leg number 2 of this massive move coming from November is now in motion. And now that we're beyond the all-time highs, guys, we're going to be looking to use this area of previous all-time highs, talking about the mid 141s. If we can put in some further distance from there, well then, as soon as we get some consolidation daily and weekly, we could be able to just sit on our previous all-time highs and continue rallying into 2024. Healthcare is set up beautifully for 2024. As I was saying early January, guys, I did believe that healthcare was the lagging sector over the past couple of years, and I do believe 2024 is going to be their year of outperformance. Now moving on to growth stocks, IWM. So IWM coming up nicely after you had a nice decrease in yields today, right? So yields coming down about 1% on the 20, about 1% on the 10-year as well. You know, the general trends of yields, guys, should now be trending towards the downside. Beautiful monthly move down as well. And we're looking out for the furtherance of the weekly downtrend as well. I don't believe, you know, as we get closer and closer to the rate cuts, guys, and rate cuts start coming in, these yields will inevitably come down. Now, looking at QQQ, I mean, IWM had a very healthy day, nice rebound off the bottom, up about 0.9%, right? But we are still in a daily downtrend, need to measure the size of the bounce in relation to 199.50. If you want to have the bulls get the best chance of reversing this, they need to put in a bounce at least to about 196. Get me a bounce up to 196, and then you have two chances. Either you can just V-shape this if the markets are performing well, or if we get all the way up there, it sets up the bulls with enough space to set the daily higher low and potentially recapture the daily uptrend in 2 steps. Keep in mind, this red box has been the area of resistance we've been dealing with now for a better part of the last 2 years. On the weekly, we've always been just looking out for this weekly tightening range. So I love to see a tightening range at the top end of a move like this, reacting nicely from our 12 EMA right here as defense as well. Never truly getting down to my buy zone though of about 187 down to about 181, which is the midpoint of this range. So far, so good. Tightening range. Need to see this tighten up a little bit, but obviously if we get a break of 199.36, well, gonna have a new weekly uptrend in this. We're gonna have a weekly uptrend continuation at this point, and we can finally get above this area of resistance that's been plaguing the markets for the past 2 years. But I mean, Russell looking fairly decent, guys, right? Looking fairly decent. Just I'm trying to be very cheap with it. I really want it below about 187. So if we had some continued, let's say February seasonality comes in and stock markets dip into the end of February, early March, I may just get my opportunity to buy some of the Russell. And now lastly, our Dow Jones. Dow Jones really stable, guys, really stable over the past 5-6 days of trading. Beautiful defense on the daily here of your 12 EMA, up 0.37% on the day. Right? So loss of this 12 EMA is going to be the most notable thing for me for the Dow Jones. Until it does that, the bulls just remain in full control. Daily uptrend underway right now, right? So we're still just looking for any daily pullback because we never lost this hourly trend. Never lost the hourly trend this entire move, right? Even back here, we lost it briefly for a day and then the bulls engulfed it, right? So no real multi-day loss of the hourly trend change. Still very healthy, right? So just looking for a daily higher low at this point, anything above 37,800. Daily higher low, further trend continuation on the Dow Jones. Weekly is looking beautiful. This looks like healthcare or financials, right? Absolutely gorgeous second weekly leg higher, and the monthly bulls at this point are in full control as well. Now we have so much space above our previous all-time highs, guys, that it will be a no-brainer once we do potentially get a weekly dip, maybe into the later stages of February. Well, these dips should be for buying. We're just looking for a weekly higher low for further trend continuation. So Dow Jones bulls in full control at this point. Now let's move down to our major tech list. So Apple performing better than most here today. You can see that Apple was one of your green big tech names. Very beautiful performance and recovery after their earnings drop in the morning after their earnings here. So Apple still stuck in this very wide weekly range, right? So we've been monitoring this range for a while now. I've been saying that we really want this range to get as tight as possible and then potentially have a break to the upside. Now, the break to the upside, in my opinion, will not be because Apple is doing something significantly better. I think it'll get carried by the market because Apple's revenue growth over the course of this year should not be that great. If they do a good job at cost efficiency, they can increase EPS and increase net margins, but it will not be coming from top line revenue expansion, which is what you want to see. So still in the midst of this tightening range right here. Key levels, of course, are your lows pretty much at the 180 level. Cannot lose these lows, but Apple bulls doing a great job at recovering. Now trying to smash through this 190 down to about 188 range, which is currently acting as resistance. Moving averages acting as resistance. If we can get over that, guys, it's going to put in a very good chance for the bulls to recover the daily trend. So if we can get above the 190 mark, it sets the bulls up nicely to create enough space to potentially reset this daily uptrend, right? And take a shot at your previous all-time highs. That would just be a break of this zone right here, the 190 range. And we're just going to be looking for a potential recapture of this high right here. 196.16 would give us a new weekly uptrend and a better chance at stabbing at your all-time highs. But the bulls still with a decent amount of work to do. But Apple, very nice recovery indeed. As I've always been saying, when Apple comes to 180, 175, that is when I'm making further plays on it. Now moving on to AMD. AMD taking a well-deserved break here today as well, down 3.64%. Semiconductors as a whole had a very negative day today, but it's normal, guys, after rallying so much in the past 4, 5, 6 weeks. Little bit of a time for a breather, well-deserved breather. Now AMD coming down. If we do lose these lows right here, 162.48, we will just be in a daily downtrend. Daily downtrend is fine, just means that weekly consolidation continues. Now we do have an area of support here, 164 down to about 158, your previous all-time highs. So I'd be taking a look at that for your first stop. Second stop is going to be your 12 EMA, which is about 151, coincides with previous weekly resistance as well. Going to be newfound support, and your 12 EMA is down there. So AMD, if it does continue like this, it's just fine. But as of now, bulls not losing it yet. They could still set up for the tightening range, which would be the best case scenario. But I would not be surprised if AMD continues to sell off a little bit and really cool off the most recent earnings expectations that AMD's earnings results weren't as fantastic as I was expecting. So it would be normal if the stock takes a little bit of a breather. AMD, I'll reiterate, it becomes a buy for me again if we do retap these 140 down to 130 areas. I know it's low, guys, concerning the current share price. It's just I wasn't a big fan of their earnings, and to justify The financial metrics, at most, I would be willing to pay 140 to about 136 for a swing trade. If you guys wanted to know what I actually want to pay for it in terms of back up the truck, it's fairly low, and I don't want to get a lot of backlash on the channel for saying this, but my true fair value of AMD at this point with the earnings that they just posted is sitting at about 108, 107. So considerably fair amount away off the share price. But I know that a lot of people like to do swing trades. So for me, a swing trade, guys, would open up between the areas of 140 and about 130, just at that point looking for a monthly higher low for further trend continuation into 2024 when they really start building on some of those new sales verticals. Now, moving on to Amazon. Consolidation after earnings, still 0.68 to the downside, but you can't really tell after the earnings move, right? So Amazon still in just a beautiful daily uptrend, just consolidation after earnings, a bit like Netflix, right? So really just consolidation here, just looking for the daily higher low, anything above 155, just looking for a daily higher low for further trend continuation. Keep in mind, Amazon dealing with the exact resistance area we pinpointed on the channel, 165 to about 170. So struggling to mount the 170 level. It's normal, guys. It's been resistance for this company a lot in the past, right? So take a look at this range that we were stuck in pretty much a better part of 2020 and 2021. The top end of that range without the little spike throughs, right, is roughly about 170, 175, has been a challenging area for Amazon in the past. That's why it's acting as current resistance. Same situation as Netflix pretty much in terms of previous ranges from 2020, 2021, still plaguing the stock today. But Amazon looking very healthy, nothing bad to say. On the weekly, still a beautiful weekly uptrend as well. If we do, for some reason, guys, get a daily downtrend, let's say, and start filling some of this gap, that's fine. Tons of space on the weekly, guys. Anything above 145, just looking for a weekly higher low for further trend continuation. Amazon should be one of the best performing tech stocks of 2024 in terms of average performance from where they started. It's one of my favorite picks. Now moving on to Google, give me a quick second. You guys know when I do Google, time for a coffee break, right? So Google up 0.33% on the day, continuing their move after earnings, right? So Google had the daily uptrend, lost the daily lows right here after their earnings. Daily downtrend is not set. That would be lower high and lower low. So we're still just waiting for this post-earnings bounce. If the bounce gets as high as your 618 level, which is about 149, let's call it, it gives the bulls the best chance at creating enough space to reverse this into a daily uptrend. So that is the scenario I'm going to be looking at for Google. But if ever we just continue to trend lower, then it becomes a heavy buying opportunity. Why? Heavy previous resistance, which is now support 141 down to 138, my sweet spot for Google. I liked Google's earnings personally, and I think they'll do well over 2024 if they can continue to reduce their costs a little bit and improve that operating margin. Now, if it does come down here, I will be playing it as a swing trade. For now, guys, just currently chilling in the 145 area. So looking good, no red flags at all. Just going to be looking out. Can they change this back to a daily uptrend here? The weekly trend was never lost, obviously, just looking to maintain that higher. As soon as we get a better indication of where the daily wants to go, we'll be able to make more plays off the weekly levels. Now moving on to Meta. So Meta pulling back as well after their earnings, right? Similar to a lot of companies that had earnings recently, just pulling back, healthy pullback on Meta, obviously. High expectations now for the stock, so daily uptrend confirmed. Just looking for a daily higher low, anything above 388 at this point, just looking for a daily higher low. In order for the bulls to remain healthy, guys, you really don't want to see them pull back, below about 450. 450 would be the best case scenario. If you really just set the daily higher low here and then reverse this and regain the hourly trend, you could be looking at higher highs. If they pull back a bit more than that after the most recent bullish sentiment, could be trapped in a little bit of a tightening range, similar to NVIDIA early 2023 when they put in their first massive move after earnings. They consolidated for a while, so I wouldn't be surprised if Meta takes a little bit of time off and just consolidates on the weekly. Everything looking beautiful as well. Beautiful weekly uptrend, just a little bit of weekly consolidation at this point, right? So just looking for that continued consolidation in Meta. And as I said previously, I would be interested in playing Meta if it gets closer, back down closer to the 400 range. I know it's a ways away, guys, about 10% away. That's just the valuation for me. Obviously, you're free to do what you want, but I would prefer to play Meta closer to the 12 EMA right here, closer to previous all-time highs, as close as I can get to 400. Now moving on to Microsoft. Microsoft as well continues consolidation. So nice little consolidation move by Microsoft at the top end of the move right here. We're going to be wary of the daily downtrend. If we flush these lows, 397.45, daily downtrend would be underway. And then you just be looking for healthy weekly consolidation after Microsoft's 4-week move, just looking for healthy weekly consolidation. I'd be targeting personally 387 level, which is going to be your 12 EMA and almost previous resistance, which should now be new support. That is only if they break the daily downtrend. But if they continue consolidating sideways like this, very possible you just get a very tightening range like this at the top end of the move, which would be fairly bullish for the stock, could lead to further price improvements in 2024. I like Microsoft, really nothing wrong with the company whatsoever. It's just having to grow into its current valuations a little bit after such a phenomenal rally from the pretty much early January. We're already up, about 12, 13% on the year so far for Microsoft. So very good, but just now consolidation sideways. No red flags until we set a daily downtrend. No red flags for further continuation. The bulls still maintaining full control of this chart. 12 EMA, line in the sand level currently, and then all the way down to 397. Now moving on to Netflix. Netflix still consolidating after their earnings, right? So this is pretty much a daily bull flag, guys. So much sideways consolidation, not giving back much on the price after such a healthy increase. So just looking for that daily higher low, anything above 476 is just looking for a daily higher low. Beautiful bull flag, trying to reach the 12 EMA currently. And in terms of the weekly, guys, you'll see why. We've been dealing with this area a lot in the past. This is what I was talking about from Amazon, right? But for Netflix, it's the 575 level. It has been a very big area of resistance in the past, playing resistance currently and just consolidating on the weekly at this point too. So weekly uptrend is very beautiful, guys. This weekly consolidation is nothing to be worried about. I think that Netflix should be able to maintain these levels. If we do start retesting, guys, if I can get as close as possible, 520, 500, that's when I'll be making a play on Netflix personally. But as of now, no red flags. If we do set the daily downtrend for any which reason, right, a little increase here, touch 571, and then daily downtrend, that's fine, guys. Just weekly consolidation. May just need to take some time off, cool off your weekly RSI. It's done a great job of cooling off your daily RSI when consolidating sideways here for the past couple of days. So no red flags on Netflix. Moving on to NVIDIA. NVIDIA, finally some consolidation, but couldn't even get it to consolidate for a full day, right? So it was down a decent amount, guys, today on the morning, right? So from morning top to bottom, almost 5% downside, but NVIDIA recovering nicely intraday, closing only 1.6% to the downside. Bit of consolidation, but it's normal, guys. In the past 3 days, it's had an increase of roughly, like 12%. So to only give back 1.6% is really nothing for the stock whatsoever, right? So any consolidation, guys, at this point, just looking for a daily higher low. Anything above 607 at this point, just looking for a daily higher low for NVIDIA stock for further trend continuation potentially. Earnings coming up here in about 2 weeks' time. So still a decent amount of time for NVIDIA. Obviously, it's NVIDIA. Anything can happen, but I would not be surprised if this is kind of the peak of this most recent weekly upswing, and then we kind of just consolidate a little bit, maybe even sideways before earnings. Everything is fairly overbought on the daily, fairly overbought on the weekly as well. So I would not be surprised if we consolidate sideways. That being said, the bulls are still in absolute full control of this stock, guys. Daily uptrend is in full control. Weekly uptrend is in full control, right? But we're going to be looking, can the bears take this hourly downtrend pattern a bit further? This would be the first hourly downtrend in a very long time on NVIDIA. So we're going to keep an eye on that. If they continue the hourly downtrend into tomorrow, just daily consolidation. Then we're going to be looking out maybe for the 12 EMA to play some defense. And then it's 607 is your line in the sand before we lose the daily uptrend here and maybe go daily downtrend into a bit of weekly consolidation, which would just be healthy for NVIDIA. So far, though, no red flags. Keep an eye on your hourly trend for tomorrow. Now moving on to Tesla. Tesla up significantly on the day, 2.25%. Very nice move off the bottoms here by Tesla. So Tesla just still caught in this daily downtrend at this point, right? Daily downtrend. And now we're looking to recapture the hourly trend. So today they did a great job of trying to recapture the hourly trend change, right? So after yesterday's lows, we're now trying to reset the hourly trend to the upside. If we break today's highs of this morning, tomorrow, hourly uptrend will be confirmed. Then we're going to be looking for the size of the daily bounce in relation to our most recent lower high, 196.30. If we can get as high as possible to 196.30, I'm talking as high as, maybe 189, 190, get me up to about 189, 190, then it creates enough space to maybe reset the daily to the bulls here in terms of a daily uptrend, and then we can start talking about how much of this weekly move down will we start recapturing. But Tesla reacting very nice from our area of confluence. It's been previous horizontal support 180 to about 170-ish, and was the downward part of this downtrending channel. So all pretty normal that Tesla is reacting down here, and we were coming off very oversold conditions as well. And now you even have a little bit of bullish divergence, right? So higher lows on the RSI, and then you have lower lows in terms of your price action. So that is called bullish divergence, usually leads to a little bit of an uptick in share price. So we'll see if Tesla can get as high as possible and give us a chance at resetting this daily trend. But for now, the bears just still in full control, but that's what we look out for on Tesla soon. Now moving on to Palantir. Palantir, guys, 31% to the upside. And going through yesterday's earnings, right, it was a challenge to find why this stock was even up 17% after earnings, because revenue came in line, and they just reiterated guidance. Nothing fancy for guidance for 2024 either, but it's true that the US commercial revenues have grown a lot, and the company is potentially due for S&P 500 inclusion, which will lead to a lot of rebalancing. Everybody who's exposed to S&P 500 as an underlying will have to buy Palantir. It's the same thing that people went through with Tesla before them being included. So potentially a little bit of a catalyst there, and a lot of retail hype behind this stock as well. But in terms of the valuation, guys, I mean, we went through the earnings yesterday and I did the math for you guys. Valuation is fairly rich for the company. That being said, this is the move that they did today. So let's analyze the technicals, right? So daily uptrend will most likely be recaptured by your bulls at this point as soon as this earnings move taper off. Just looking for a daily higher low similar to exactly what we saw on Amazon, Netflix, and the others, right? So just looking for a daily higher low at this point as soon as we consolidate. And now the previous area of resistance will now be support all the way up to where we currently are, right? Just trapped in this zone. It spiked up once here in the past and then retraced all the way back down to about $20. So if we do retrace, guys, I'm expecting the lower end of this range right here, 20.25, to be acting as your next most likely area of support for a potential daily breakout, retest, and then try to mount the levels. But just keep in mind, guys, our next areas that we will be looking at is where most traders have been stuck in for the past couple of years, right after IPO. This is where most people had been trading Palantir between 23 and 26. So if we do mount successfully, but above 22, we have a bunch of resistance, 23, 24, all the way up to about $26, right? So a lot of trapped equity in here. We'll see if that puts a big selling pressure on Palantir, but so far, so good. I hope that they're able to close the weekly candle like this, because this would lead to a very bullish continuation pattern. Everything looking very good in terms of the technicals here. Not even that overbought on the daily RSI, so we'll see how they progress as well. And now lastly, PayPal. So PayPal, nice little push up moving into earnings, but can't comment much on the price action, guys. Just consolidation here, tightening range, moving into earnings. We're pulling in to crucial territory for PayPal, okay? Why? We're coming up on, obviously, this downtrending trend line. If PayPal gets a nice earnings and we can close here, guys, tomorrow in the high $60 range, that will be a break above one of our massive downtrending trend lines here that we've been stuck in for almost the past year and a half at this point, and we have been consistently above our moving averages. Look, we haven't been consistently above the moving averages. 12 now crossing above the 26, which hasn't happened ever since the drop off pretty much. So a lot of bullish technical catalysts coming together. Just remains to be seen, can they deliver on earnings tomorrow? Earnings tomorrow, in my opinion, guys, will send us to one or two zones. Either we're going to crack the 68.17 and really start mounting the levels, after which your next area of resistance quickly becomes 75.50 area, which has been a big area for the stock in the past. We'll talk about it if we get there. And to the downside, if they just disappoint, and I'm not saying they're going to miss earnings or anything like that, but the expectations on PayPal are really high now. So there needs to be some good deliverance of guidance and good deliverance into how these new measures that the CEO was talking about 2 weeks ago are going to translate into EPS, cash flow, and margins over the next couple of years. If they can do that successfully, should be a good time. If they fail to show how these new advancements are going to translate into bottom line improvements of margins and free cash flow, well, then you may have a little bit of a sell-off, and the sell-off could take us between $60 and about $57. The expected move is about 6%, so 6% from current prices could put us into this consolidation range down here, or could make us break your previous 52-week highs. So we'll take it when we get there, but I'm fairly bullish on PayPal as a whole for the medium to long term. So that's everything I had for you guys for your technical breakdowns. Let's take a very brief look at my portfolio. So taking a look at our portfolio, guys, you will see that we are now positive on the year-to-date performance, up about 1% from the beginning of the year. Obviously still underperforming SPY, which is up roughly 3.63% on the year. But as I've explained previously on the channel, we've got exposed to a lot of names that are exposed to China and a lot of names that are interest rate sensitive plays as well. So that being said, we've been writing a lot of premium in the past 3 weeks on the channel, pretty much $1,000 or better dollars in terms of premium written in the past 3 weeks, every single week. So very happy about that. Was just waiting for our underlying positions to recover. And that's when the account will really get some lift here, because the whole time we've been writing a lot of premium. So as soon as our underlying stocks do recover, that is going to take the portfolio into turbo mode and really start gaining levels on the year. Looking forward to it. Now, let's take a look at our holdings here, guys. So not much has changed, but a few things have. So let's go through these quickly. CSIQ still have the 23 calls for this ending Friday that we got for about 23 cents, ending about 5 cents here. But CSIQ did have a little bit of a lift after Enphase earnings in the after hours. So Enphase earnings after their earnings today were up pretty much after the close about 13%. So should have a little bit of lift on CSIQ tomorrow. CSIQ, just keep in mind that we were assigned pretty much higher in the $35 range. We dollar cost average 200 shares at $25, and then we've been writing premium aggressively on it the whole time that we've been dropping. So average cost is about $25.69. Now, our covered calls for this week are about at 23. May or may not get to there. We'll see what happens, but we'll be continuing to roll those calls forward and continuously writing aggressive premium, $23, $24, trying to bring our cost basis back. I don't think this one will recover much before March, April, May, when we really start getting closer to that decrease in interest rates. And then the next play we have that we took yesterday is Caesars Entertainment. We took the 41 puts, which was featured in my Sunday night video. Got about 0.5% for those, so 23 cents. They're actually trading lower than 20 cents right now. They're trading about, anywhere between 8 to 11 cents. So we're already 50% profitable on those. Caesar coming up nicely on the day here today. So you'll see that our strike price is right down here about $41, and it gives us current cushion of about 5.5% for the next 3 trading days. So we should be able to just close those positions worthless. Very beautiful area of overall support here for Caesars down in the lower $40 area. That's why we took that one. Palantir, we had these 17.5 calls leading into earnings. Obviously, we were unsure which direction Palantir would head after earnings. And the technicals, the technicals were very hard to read as well. Couldn't really get a sense of where it was going. And we didn't have that much increased guidance over the course of the quarter. So it was really anybody's guess. But we did do a good job in trading the premium for what it was, right? So 65 cents for the 17.5 calls. That's a very hefty premium, guys, right? That's a very hefty premium when you take into account 65 cents divided by roughly your 17.5. That's roughly 3.7% for the week that we got on Palantir. So we will be called away at 17.5. We got these shares at $18 earlier on, about 3-4 weeks ago at this point on Palantir. And ever since then, we've been able to write a little bit of premium on them, bringing our total cost down to about 16.67. So now we'll be called away at 17.5. So represents a gain of roughly 4.8% over the last pretty much 4 or 5 weeks. So that should be a weekly gain here of roughly 1% on those shares. Very happy with this trade. Obviously, we didn't get it in the trading account. I do have some shares in my long-term account, so I'm not too angry about being called away so low on the stock, but I'm very happy with our management of the position. We wrote exactly what we wanted to in terms of our weekly premium amounts in terms of percentages. So very happy with that play on Palantir, even though we're getting called away here shortly on Friday. PayPal, we have these $64 calls leading into Friday. Now, guys, PayPal, I've been in this one for a while. This, in my opinion, is going to be the make or break quarter for PayPal. Well, it's not really going to break something, but this is really the quarter that they can make it, or we're just going to have to wait just a little bit longer. The downside risk, in my opinion, is not that great because the company is performing well, but the upside potential is fairly good though too. So we were coming into earnings here with about 64 calls that we got for about $1.63. Very juicy premium. Our average cost on PayPal for the shares that we got assigned on $67.50 is now down to about $62.45. We're trading right under 64. Now, guys, if you ask me for my gut feeling for earnings tomorrow, I do believe that this one is going to be going up on after earnings. There's a lot of hype built into the stock already, and I do believe that any positive guidance and reinforcement of previous statements by the CEO are going to translate into a hefty little pop. The technicals are looking good. The fundamentals are looking good, and we do have a more bullish sentiment as a whole around the stock and its turnaround story now. So what I might do, guys, is I may take a little bit of a gamble. I may just take these calls off. Now we're down about $1 on these calls each, so that would just bring my average cost from $62.45 to $63.45, still significantly below my assigned price. We're going to be taking potentially a little bit of a gamble on PayPal tomorrow. I may just want to let these run and see how we perform. Worst case scenario, guys, that's fine. Worst case scenario, we'll just end up back in the 60 to 55 range, and then I'll just be looking to reduce this average cost by writing more puts down here. So not a sizable position for me, only 200 shares. That's why I'm willing to take the risk and maybe let these run into earnings. Now moving into Baba. Baba's another one that I want to cover for you guys here. Baba with earnings tomorrow. So Baba is a stock that I got assigned at $82 back here on November 17th. Now, since then, we've been able to write a bunch of premium and collect a dividend, and our average cost is down to about 78.52. Now, I'll show you what I did today. So yesterday, after yesterday's significant rally, I wrote the 79 calls for 98 cents, so over 1% for this Friday. But then the stock moved up higher today again. So Baba, I'm once again going to take a chance similar to what I just explained on PayPal. We're going to be taking a chance for earnings, which is why I rolled the calls up. Now, I closed the 79s, which you'll see down here, which I just got yesterday, and I rolled them up to $82 calls for next Friday. So I want to get back to my cost basis, good momentum. Chinese government backstopping the stock market now at this point, and Baba, high free cash flow, decent margins, decent revenue expansion, decent EPS. It has amazing fundamentals. So any surprise tomorrow on the fundamentals should give this stock some lift. So that's why I'm willing to take a chance on Baba. Worst case scenario is fine. If we just dip down in the lower $70 range, I'll be looking to lower this average cost by writing more puts and maybe even going for some leaps. If you guys remember, I picked up some leaps in early January here, and we made about $500 on those. So we'll be just looking to do that again if it redips there. But best case scenario, to roll these calls from $79 to $82 only cost me about $40, guys. Only cost me about 40 cents on my average cost. Not that much. We'll do the math together, right? So we wrote the $98 calls, so 0.98. Then we had to buy back those calls and then write the 82s for next week. So minus 65. Right, so excuse me, let's just do these on dollar increments. So 98 minus 65, 33 plus your 26 here. So about $59 in total credit. So instead of getting a $98 total credit, we only got about $59. So that's about a $40 hit that I took from writing these initially, right? So instead of getting 98 total credit, we only got about 59 total credit for the next this week and next week. But what did we do? Right? For a move that only cost us about $40 in terms of our total average cost, bringing it up a little bit, we gained an extra share capacity here, an extra dollar per share increase of about $3. So sacrificing $40 to make $300 more potentially sounds like a good risk to reward for me. And as I explained, the downside, I'm fine with buying more Alibaba down there. So that's what I did in terms of rolling the calls upwards and taking a $40 loss to get a $300 per share gain potentially. And then what we did as well is we wrote these 69 puts. So we wrote the 69 puts, which is for about 25 cents, which is what helps bring our average cost down a little bit more on our roll here today. So 69 will be some shares if we do dip down there to earnings. The expected move on earnings is about 6%, and I really wrote these 69 puts here down about 12% off of current share price. So that's a 2 times the expected move. It helped reduce the cost basis of the roll that we did from 79 to 82. So that's why I chose to write those 69 puts as well. We'll see what happens with that stock tomorrow. Then next we have Fortinet. So Fortinet was a play that I took before earnings, 55.5s. Now I'll show you guys why I take these plays, even though I recommend to stay away from earnings plays, guys. I only took these plays because it was twice the expected move. The expected move, guys, was roughly about 6%. So it was about $63, $62.50 pretty much, 6-7% expected move. I wrote the 55.5s, which is literally about 18% off the current share price, right? And 55.5 would be right back into my sweet spot zone that I wanted to be picking up shares this entire time, right? So that's the only reason why I do some of these earnings plays, guys. Every single earnings play you see me take, you'll always notice that it's at a level that I'm very comfortable buying the stock and a level that I've been talking about a stock for a very long time. That's why I chose to do these Fortinets, and the risk played off because now Fortinet, obviously in the after hours, trading about $75. So this Fortinet position should be worthless. So for 18% of downside risk, I was able to get roughly about 0.5% here, 29 cents. Those will be worthless by tomorrow, so just pocketing more premium. Google, the 145s, we got assigned 100 shares of Google calls at 145 after their earnings last week. We were able to write 145 calls for $1.16 on Friday, right? So now Google total cost basis, we wrote the puts for about $1. We got $1.16, so $2.16 off of 145. So we should be sitting about 142.86 should be the average cost, and Google currently trading above 145. So if we get called away, it's fine. We'll make about $215 on Google in the past week and a bit, which should be in the high, 1.7, 1.8% range for 2 weeks of trading, which is not that bad at all. Looking forward to collecting that premium on Google if we do get called away. No problem at all. Have managed this position pretty well. Then we have the Starbucks $94 calls on for this week. Starbucks now above 94. So if we get called away on Starbucks, that is completely fine. I'm fine with that, guys. Our average cost is now down to 93.58. We're collecting a dividend as well this week as well. So very happy about that. If I get called away on Starbucks, so be it, right? We might be called away on a lot of positions this week, right? We may be called away. We're going to be called away on Palantir. We have a risk of potentially being called away on Baba over the next week. PayPal, I'll let this one ride, but may be able to be called away on it in the next week or two if it rises as well. Google may be called away. Starbucks may be called away, and even UPS will go now that one may be called away. So I'm getting called away on potentially a lot of my positions here, which is why I really like this portfolio's performance over the course of this past week. So Starbucks, have those engaged, and if we get called away, perfect, so be it. Have underperformed in terms of my weekly premium amount since being assigned back in December, but that's okay here, guys. We did have a heavy little drop. I was able to drop my average cost a little bit, but now the stock moving above before I had time to write enough covered calls to really drop this more. Now, moving on to Trade Desk. Trade Desk still have those 71 calls for next week in terms of earnings. Trade Desk currently trading around, $68, so not much premium has come out of these covered calls. But just to remind you, we got assigned on Trade Desk at 72, and with the amount of premium that we've written, our average cost is now down all the way to about 64. So very happy about reducing my average cost by about 10, 11%. And this has been a very juicy trade in terms of weekly ROI. If you do the math, about 5 weeks in the trade now, and we've been running pretty much, 11% discount from assignment. So running about 2% per week in terms of average weekly ROI. Now moving on to UPS. UPS as well got assigned at 145 last week. You can see those shares right down here. Break even before these calls was about 143.93. So that's $1.07 that we got before earnings for the puts. Now we've wrote the calls for about 145. Now you'll see here that we wrote the 145s today, and UPS currently still trading after a very nice day today, up 5%, trading above 145. So if we get called away, same thing like Google, I will not be mad here, guys. We'll just pretty much pocket $300 on UPS over the past 2 weeks, which is fine for me. Respects my weekly minimums, right? We're pretty much average between these two. Let's call it about 290 would be about $2.90 divided by 2 is roughly 145. That would be 1% per week, right? 1%, $1.45 last week, $1.45 this week. The average of these two, 1% per week. That's exactly what I want to be doing. So wouldn't mind being called away on these as well. And the rest of the swing trades, guys, are still active pretty much. Right, TMF still have this 20-year bonds. ETH and Bitcoin haven't added to it. And the rest of the things we've gone over, except for Nike. Nike's the only one that I haven't been able to write any covered calls on for the past couple of weeks. Everything else, guys, have a good chance of potentially being called away here, right? So Google might be getting called away here. Starbucks might be getting called away. Trade Desk earnings next week, we'll see, but maybe getting called away if they do well. UPS maybe getting called away. Baba as well. Palantir getting called away. PayPal maybe even in the next couple of weeks. CSIQ still our laggard play on the whole account at this point. Still down a considerable amount on those since from my true cost basis of 25.9. We'll continue to chip away at it. And my Canadian banks now still a bit down after those most recent interest rate headlines. So all in all, guys, great recovery by the portfolio, good premium being written by me to manage all of the positions in the past couple of weeks. And as our underlying stocks continue to recover, we should be able to start outperforming the S&P 500. And as we get called away these positions, guys, keep in mind that we will recapture a lot of buying power too, which is going to allow us to just get back to normal and writing new puts for the put wheel strategy. So hopefully this has been educational for all of you. If you liked the video, consider dropping a like, would really appreciate it. If you also want to subscribe to the channel, if you like this kind of content, please click the subscribe button. We'd love to have you. Almost 700 of you have subscribed so far. I love each and every one of you for it. Thank you so much for your support, guys. It means the world to me. And as always, if you have any questions whatsoever, feel free to leave them down below in the comments, guys. I'll always answer you within the first 24 hours. Anything, stocks, TA, options, whatever you want, leave it down below in the comments and I'll get back to you. So take care. See you tomorrow after the close. Peace.